What's going on, y'all? Welcome to another edition of Weeds Weekly, where I, Kevin, just break down really quickly what happened this past week with regards to interest rates, the mortgage market, so on and so forth, as well as what we can anticipate for this coming week, right? We want to be educated and making decisions with regards to purchasing, refinancing, etc. We're also going to cover a few hot topics. I think number one is going to be not moving the needle. Look, we were told with interest rates, once they get below down into the 6% range, that we should see increased activity. Where is that activity? And then lastly, we're going to touch on do not pay again. There's news everywhere with regards to refinancing, so I like to have a couple rules of thumb that I discuss with my clients so that they can make good, educated decisions, because refinancing costs money one way or the other. So let's dive in real quick with what happened this past week. And the big thing that came out this past week is that, look, the overall health of the economy seems to be intact. The fear of a recession is really not on the table. We may, as a matter of fact, been coming out of one. But GDP, once again, beat forecast, came in at 3%. We also had consumer confidence up, so that was really a good indication of where the economy is from the Fed's perspective as they're looking at the reduction of interest rates. The other thing is, look, inflation continues to come down. It does have its slow drip. It seems like, well, whether it's the last 4 or 5 months, every month we're getting a 0.1% decrease in inflation, whether it's PCE or CPI. That seems to be the general trend, which is exactly what the Fed is looking for. But we said it a long time ago, the Fed's target rate is about 2%. They are going to start acting when it is about 2.5%. So yes, the number's a little bit higher than what the Fed would like it to be, but again, it looks like they're going to need to act sooner rather than later. And is it time to panic? I mean, this past week we saw pending home sales plummet to its lowest levels that we have ever seen. And I think it's a combined thing, right? I think now that we're coming out of the higher interest rate phase, I got a lot of clients that are just sitting on the fence. They're anticipating lower interest rates. They're anticipating maybe further price cuts. They're anticipating, they don't know what's going to happen with the election. And as we remember, the election always puts people in quicksand. So that is something that is definitely out there, that is on people's radar, and so on and so forth. So what do we have this coming week? And we have a huge week this week, right? And Friday is going to be a clear indicator. It's 100% going to be the indicator of what the Fed is going to do come September 18th. Look, jobs is the biggest thing that the Fed is looking at now. With inflation, as we just discussed last week, clearly indicating that it continues its 0.1% decrease month over month. The labor market is now the number one concern. Last month's non-farm payroll came in unexpectedly low. Unemployment rose to 4.3%, so we have some reduction to those forecast numbers this time. But again, should we see numbers like we did last month, I think what it's going to do, it's going to cause the Fed to do anywhere from a 3/8 to a 0.5 point decrease in the Fed funds rate. Should we remain steady? Should it be that, numbers come in right around forecast? I don't anticipate anything different than the 0.25 point that the Fed is already on the table, has already basically indicated that they are going to do. And what do I expect? I actually expect that to be the case. I think that the numbers are going to come in a little bit light. However, I also believe that, they're not going to be as drastic as they were last month. We did have that hurricane. Those numbers absolutely factor into unemployment and to filings for non-farm payrolls. So therefore, I think that we had a slightly skewed number this past month. And then the other thing we have to remember, and here we are now, 64 days away from the presidential election. It is creeping up on us. It was in the forefront after that debacle of the debate. Biden got pushed out. We now have Kamala Harris in. And I think as this starts to heat up and we get through the Fed of September 18th, the new focus for a lot of people is going to be this election. And as we've already established before, it's been proven through history, people get in quicksand. And the other thing to note is, during a presidential election, the month prior, which would be October, pending home sales are down 15% on average. However, what I like to say is anytime that you see something slowing in the market, everyone's moving in one direction. The people who are brave enough to find opportunity in that are the ones that are going to succeed. So remember that, right? I've been saying it now for a long time. The time to act is now. You have a plethora of inventory, especially in the Austin marketplace. You have anticipated rate drops coming throughout the course of 2024 here coming up, as well as 2025 and into 2026. And you have sellers who are still willing to negotiate, and that is not going to last forever. Seller concession, move-in dates, home repairs, a plethora of things that home sellers are going to be willing to discuss with an offer on their home that come after the election and come into the new year. That is not going to be the case. All right, so despite falling interest rates, why are home sales slowing? And I think the main thing, I already touched on it right there, is the two things that have people trying to outthink the market. They believe that, the perception is, and it's all over the media, that the Fed is going to reduce interest rates. What clients tend to forget is that the market is forward thinking. So once we get through this Friday, and we know that non-farm payroll, we're going to know exactly what the Fed is going to be doing, right? So sitting and waiting for the Fed and interest rates to drop, where they're going to cut the Fed funds rate a quarter point, and you think that's going to be a direct correlation to interest rates, that is not the case. The market is already baked in this quarter point. So again, unless we see just a drastic missed number in the non-farm payroll, we are not going to see a further reduction in interest rates, and we are going to be riding this level that we're in right here, right now with interest rates for till the election cycle, because it's going to be pent up angst with the election. So therefore, you're going to see traders, hedge, be very reluctant to really dive in and anticipate what the Fed is going to do, because the element of the presidential election is one that we just don't know until the outcome is already there. So that's number one. The other thing is, I think a lot of homeowners not homeowners, but a lot of buyers anticipate that housing prices are going to drop. So you're seeing that also. I'm talking to a lot of people. They believe that a further price correction, depending on where you are in the country, is something that's going to happen. And I can tell you this, from analyzing data and from talking to numerous real estate agents, we are essentially near the bottom. You are not going to see a huge influx of inventory that could potentially cause pricing to decrease, nor are you going to see sellers panic. Everyone's going to be kind of in a wait and see, a pause as we head into this election, and then you have the holidays, and then you're going to have a kickstart come 2025. There is not going to be a major reduction right now in values, in home prices, that you can anticipate. Now, again, can you offer anything you want? Absolutely. Might somebody take your offer because they're in a situation where they need to? 100%. But you're not going to see pricing across the board come down. So if you're one of those people sitting on the sidelines, or your clients are, go back in history, go through the numbers with them to get them off that fence. And then the last thing I wanted to cover is do not pay again. I'm seeing it all over, the newspaper and the media and online. Is right now a great time to refinance, right? Are you ready? Should you be doing it? And the main thing I want to take away from that is, look, the only people that should really be considering refinancing are the people that closed late September of last year till mid-November. You were in the mid-7s to the mid-8s on an interest rate. So does that make sense right now for you to be picking up the phone and shopping it to several lenders? 100% it does. For everyone else, the reality of paying closing costs again when you're not going to be saving at least 1% in an interest rate, the numbers just don't make sense. And I'm always happy to go through with any client that you may have, or even with you for a client, so it can look as if you did it. So please don't hesitate to give me a call. But here are general rules of thumb that I like to talk about with my clients and anyone that's considering a refinance. Is number one, know the costs that were associated with your current loan, because they are a factor in whether you want to refinance now or not. You also want to have a good idea of how much longer you plan to live in the house. The average American lives in the house for 13 years, but the average person sits in their current mortgage for less than 7. That's a big difference. So you want to make sure that you know those numbers. Number one, know all the closing costs associated with your refinance. Do you need to make something up in escrow? Do you have an increase in your home insurance? There's several factors that play into that, so you want to know that so you can determine your break-even point. You also want to compare the interest that you're currently paying in the schedule that you're going to have over the timeline that you're going to be in the home to the interest that you're going to be paying on the new loan. Remember, you're going to be resetting typically the term of that loan from 30 years to 30 years again. So you want to know the interest that you're going to be paying because every loan is front heavy interest. And again, that's money. So you want to make sure that you know those numbers. Number 5, you want to do the math in your monthly payment reduction to your closing costs. You want to know that break-even point, right? If you're going to say, if your closing costs are $5,000 and you're saving $200 a month, you're going to be looking at a 2-year, 2-month break-even point. And again, now it's going to take 4 years and 4 months for you to double that. So you want to make sure that you're going to be in the home for that long and those numbers make sense to you. And the other thing, I encourage it all the time, seriously consider a no-cost refinance where somebody in my position increases your interest rate, takes that extra yield spread and gives it back to you to pay for all the closing costs. So in essence, if you were to close at 7.5% and I was able to give you a no cost at 6.75% by just giving you a slightly higher interest rate, it's as if when you went to close on that purchase, you actually got an interest rate of 6.75. There's no additional cost to you. You're not increasing your loan amount. And it's something that you should seriously consider and at least know that as an alternative so that you know what that number is and you can do the math as it associates whether to pay the closing costs or to take the no-cost refinance. And the other thing is, don't listen to the media. If you're curious, pick up the phone, talk to a couple of educated professionals that can crunch numbers for you, do the math for you, and help you make the best educated decision for you and your family. All right, y'all, have a great week out there. I apologize about coming to you late. I've been traveling, was seeing my family here in upstate New York, which was a great trip. As you can see, I'm sitting here at the train station. I am off again, headed to Connecticut and New York City. But I am around, I am working. You need anything, you give me a call. And remember, the big number is Friday. That will really determine what the Fed is going to do on September 18th. And it should be able to be an opportunity to get a lot of people off the fence, pick up the phone, talk to a lot of clients, and tell them exactly what you can anticipate as you head into the months of the remainder of September as well as October. All right, y'all, you need anything, give me a call, text, or email. Be happy to crunch any numbers for you, and happy selling out there. Have a great week. Cheers.